Hey everyone, welcome back to the channel. I'm your host Ian, and today we're tackling the urban explosion in Vancouver and Toronto between 2015 and 2017. This was a time when home prices shot up 18 to 33% year over year, fueled by foreign buyers, rock bottom interest rates, and a wave of speculation. First, a bit of context before the madness really hit. Coming out of the global financial crisis in 2008 and 2009, Canada's housing market had been on a steady climb for years, thanks to low borrowing costs and a growing economy. By the early 2010s, prices in Vancouver and Toronto were already high compared to incomes, but nothing like what was coming. In Vancouver, the benchmark price for a home was around $600,000 in 2014, and in Toronto, the average was about $566,000, not far off. People were optimistic. Real estate had been a reliable wealth builder for generations, especially in these booming cities, but there were early warning signs that something dramatic was about to happen. Economists and the media started talking about overvaluation, with reports from places like the Canadian Mortgage and Housing Corporation noting that demand was outpacing supply, and foreign investment was starting to heat things up a bit. Many Canadians at this time viewed property as a safe bet, something that would always appreciate over time. There was this underlying belief that you can't lose in real estate, a story we heard over and over again throughout the generation, especially in urban centers where jobs and immigration were drawing people in. But a few voices, like in financial blogs and op-eds, were cautious about unsustainable growth, comparing it to past bubbles in places like the US. Then, bam, 2015 to 2017 hit, and it was like someone flipped a switch. Prices in Vancouver and Toronto went into overdrive. In Vancouver, the average single-family home jumped from about 1.3 million in 2015 to 1.66 million in 2016. That's a 28% surge in just 1 year. By the end of 2017, the composite benchmark price for all residential properties in Metro Vancouver had risen another 16% to over $1 million. Toronto wasn't far behind. In 2016, home prices across the Greater Toronto Area climbed rapidly, with average resale prices hitting around $730,000, up about 17% from 2015. But the real frenzy peaked in early 2017. By March, prices were up 34% year over year in some segments. We're talking bidding war, homes selling for hundreds of thousands of dollars over asking, and year over year gains hitting 18 to 33% in detached homes and condos alone. Data from the Toronto Real Estate Board and Greater Vancouver Realtors showed sales volume spiking too. Toronto saw over 113,000 transactions in 2016, a record at the time. It felt like everyone was jumping in, from first-time homebuyers to investors flipping properties. So what sparked this explosion? Well, it was kind of a perfect storm. First, we had our low interest rates, courtesy of the Bank of Canada keeping the overnight rate at historic lows. People could afford bigger mortgages, and that pumped more money into the market. Second, speculation ran rampant. Investors, both local and internationally, treated homes like stocks, buying up properties expecting those endless appreciations. Reports from the time estimated that in Vancouver, up to 20% of high-end sales were to speculators holding empty homes or flipping them quickly. And then third, foreign buyers got a lot of the blame. In both cities, but especially Vancouver, there was an influx of capital from overseas, particularly China. Stories flooded the news about wealthy international investors parking money in Canada real estate to escape economic uncertainty back home. 2016 studies suggested foreign ownership was pushing prices up by setting new highs that locals then matched. Combined with population growth, where Canada's immigration policies were bringing in hundreds of thousands of new residents annually, many settling in these cities, and a lag in new housing supply, it created this frenzy. Economists did debate the exact impact of each of these things, but public perception was very clear. Foreign money was inflating the bubble. People had 2 points of views, but excitement dominated at first. In 2015 and 2016, many saw real estate as an unbeatable investment. Headlines cheered the hot market, and folks at dinner parties, they started bragging about their gains. Social media and forums were full of stories like, "I bought a condo and it doubled in value in 2 years." Sounds incredible. There was this fear of missing out that drove even cautious buyers to stretch their budget as far as they could. Polls from the time, like those from Ipsos, showed a majority of Canadians believed home prices would just keep rising. The constant repeating thought that exists in real estate. With about 60% of Toronto viewing property as a solid long-term bet. But underneath all of that, there was fear growing. By late 2016 and into 2017, warning signs about a bubble started to grow a little bit louder. Articles in the Globe and Mail and CBC called it Canada's property bubble, comparing it to the US crash in 2008. Although there was a lot more going on in the US, which caused that bubble. Economists from Deutsche Bank and others listed Canadian housing as a top global risk. People weren't blind. They knew prices were detached from incomes, where the average Vancouver home cost 12 times the median household income. Toronto was also about 8 times, but greed won out for many. That's when the government stepped in to cool things down. In BC, the big move was the 15% foreign buyers tax introduced in August of 2016. It targeted non-residents investing in Metro Vancouver, aiming to curb speculation and make homes more affordable for the locals. The impact was very swift. Sales dropped 26% in the month after, and the price growth really slowed down. Studies later showed it reduced annual house price increases by 5% through 2017, though some argued it shifted demand to other areas. Ontario followed suit in April 2017 with its own 15% non-resident speculation tax for the Greater Golden Horseshoe. They paired it with expanded rent controls, capping increases at inflation for all units, not just older ones, to protect tenants from skyrocketing rents amid the boom. Rent controls were controversial. Landlords said it discouraged new rental builds, but it addressed complaints that speculation was jacking up costs for renters. Sales in Toronto plunged 50% in May 2017, and prices fell 18% over the next 4 months. These measures didn't burst the bubble overnight, but they marked the end of the wild ride. Post-2017, the markets shifted into correction mode. In Vancouver, benchmark prices dropped about 3% by 2018, with high-end homes falling 15 to 20% from those peaks. Toronto saw average prices stabilizing around $750,000 by 2017, down from the March high of over $900,000. Sentiment turned cautious. People who bought at the top, listings piled up, and the up forever crowd quieted down for a bit. The media called it a soft landing, but for many, it felt like a reality check. Affordability improved slightly, but the underlying issues like supply shortages, well, they lingered. Looking back, this period showed how quickly markets can overheat when cheap money meets speculation, and how policy can really start to rein it back in, pull it back into reality. So what can we learn from Vancouver and Toronto's wild ride? Real estate, well, it isn't always a one-way street. Bubbles form when fundamentals get ignored, and corrections hurt, but they also create opportunity for a balanced growth. If you're thinking about buying or selling today, remember, understand the data, watch the sentiment and what people are thinking, and don't chase the hype. Thanks for joining me, and I'll catch you on the next one.